Welcome to the Paycheck Project. Don't forget to hit the like and subscribe button.
So the Fed just cut interest rates, and it feels like it's all anyone's talking about. But what does a tiny quarter-point drop actually mean for your wallet, for the money in your bank account or that credit card balance? Let's cut through the noise and break down what really matters.
Okay, let's just get right into it, no waiting. Here's the snapshot. If you have a standard 30-year fixed mortgage, honestly, not much is going to change for you right away. But if you're on an adjustable rate mortgage or have a HELOC, good news, you're probably about to see some relief. Credit card rates, they'll nudge down a bit. Car loans, that's a whole different ballgame. And your savings, if you've been loving those high-yield rates, this is your sign. They've pretty much peaked.
So that's the what. But the why, that's where the real story is. Why did they do this now? I can tell you it's not because the economy is crushing it. The real reason is, well, it's a lot more dramatic than you'd think.
I want you to picture the Fed walking a tightrope. Seriously. On one side, you have a weakening job market. And if they step that way, they could tip the whole economy into a recession. On the other side, the fire pit of stubborn inflation. One bad move and things get messy. That's the crazy balancing act they're trying to pull off right now.
And here are the two main characters in this drama. The big reason for the cut is the job market, which is clearly cooling off. Unemployment just hit a high we haven't seen in almost 4 years. But, and this is a huge but, here's the plot twist. Inflation is still hanging out way above the Fed's target. A slowing economy with high prices? Yeah, that's this weird, uncomfortable situation some are calling stagflation-lite.
So, what do you do? Well, Fed Chair Jerome Powell basically told us himself. He called it a risk management move. You got to understand, this wasn't a victory speech. This was the Fed playing defense. They're basically taking out an insurance policy, trying to stop a weakening job market from turning into a full-blown recession.
Okay, so the Fed is in defensive mode. Let's translate that into what it means for probably the biggest check you write every month: housing. First, let's just go ahead and bust a giant myth right now. You might hear the Fed cut rates by a quarter point and think, sweet, my mortgage rate is going to drop by that much. Nope, it doesn't work like that. The market is smart. It saw this coming from a mile away, so that potential drop was already priced into mortgage rates weeks ago. The discount was already applied, so to speak. So here's the real breakdown. If you have a fixed-rate mortgage, your world doesn't change. Your payment is locked in, that's the whole point. But, and this is for a lot of you, if you have an adjustable rate mortgage or a HELOC, now you need to pay attention. Your rate is variable. It moves with the market, which means your monthly payment is very likely about to go down. That's real money, back in your pocket, probably in the next 30 to 60 days.
All right, let's pivot from housing. What about the day-to-day stuff? The credit cards we all use, the car loans, and, of course, the cash just sitting in our savings accounts.
Now, if you're carrying a balance on a credit card, your variable APR will technically go down. But let's be real for a second. A tiny little dip when the average rate is still over 20%, it's not going to change your life. You know how it is? Banks are lightning fast to raise your rates, but they take their sweet, sweet time bringing them back down.
Okay, savings. Brace yourself for this. The national average interest rate at one of those big traditional banks is a whopping 0.38%. I'm not kidding you. That's basically zero. Your money is doing nothing for you there.
Now compare that sad number to this. The top high-yield savings accounts are paying out over 4%. Some are even pushing 5%. Yes, this Fed rate cut means those amazing yields will start to drift down a little bit, but the gap is still absolutely massive. If your emergency fund isn't in an account like this, you are literally leaving free money on the table.
So, since we know the Fed is probably going to cut rates again, here's a pro move you can make. The CD strategy. It's super simple. You know those high-yield savings rates are going to slowly fall? So, a certificate of deposit, or CD, lets you grab today's awesome high rate and lock it in for a set period, like 1 or 2 years. It's a way to guarantee that great return while everyone else's rates are sinking.
So we've covered the what, the why, and how it all hits your bank account. Now for the most important part. What should you actually do? Let's put together your personal action plan.
Okay, it's time for a quick financial checklist. First, pull up your statements. If you have an ARM or HELOC, you're looking for that lower payment to hit. Next, literally pick up the phone and call your credit card company. Use this rate cut as a reason to negotiate a lower APR. And look, with the Fed worried about the job market, this is your wake-up call to make absolutely sure your 3 to 6 month emergency fund is fully loaded and ready to go.
Look, this isn't a one-and-done deal. The Fed itself is already projecting 2 more rate cuts by the end of next year. That means the entire financial world is going to keep changing. So the only real question left for you is this: is your financial plan ready for whatever comes next?